We now move on to our next segment on regional investments, and we have Ms. Megha Agarwal, Partner Corporate and Hospitality at Khaitan & Co. as the moderator. Megha advises hotel owners on management and franchise agreements with leading operators such as HCL, Marriott, Hyatt, IHG and Agarwal, and has also worked with operators on management arrangements in India. Joining her on stage are Mr. Gautam Birudavolu, Chief Executive Officer, GreenPark Hotel and Resorts, Mr. Manvendra Singh, Shekhawat, Managing Director, Suryagarh Collection, Mr. Nathan Andrews, Strategic Advisor, DS Group, Mr. Shwetank Singh, Managing Director and CEO, Chalet Hotels, and Mr. Vikram Lalvani, Managing Director and CEO, Sterling Hotels Resort. Please give them a round of applause.
Good morning, everyone. It's a pleasure to have such a distinguished panel with us today, and I'll start right in. So if you look at where hospitality growth in India is coming from today, it is no longer just the metro cities like Bombay or Delhi, but it's also from markets that historically weren't the center of hospitality investment. And from what we saw from the data yesterday as well, it's becoming increasingly clear that while global supply growth is slowing, India continues to expand, and that expansion is regional and diverse. Demand on the other side also is steady. So the shift is already underway, but what we're really hoping to unpack in the next few minutes is what separates regional investments from those that work and those that don't, and how do you identify the right regional opportunity in India. So before I go to the panel, we wanted to do a quick pulse check. There'll be a poll on your screens. You can log on to the Hotelivate app and select a response. It should be up right in. Can we have the poll, please? We'll just give it a minute. Yeah. So the question on your screen is, what will drive hotel demand in regional India over the next 5 years? Wedding and MICE, leisure, corporate, or infrastructure? Wedding and MICE seems to be leading it so far. Okay, great. So wedding and MICE definitely is leading that. And let me start with what the panel thinks about it. So Gautam, we'll start with you first in terms of what makes a regional investment work. You've really built a lot of depth in markets like Chennai. So does cluster depth within a micro market reduce risk more?
Sorry, the audio is little...
Sorry, I think it is echoing a little bit, yeah. So the question really is, you build strong clusters in markets like Chennai, so would cluster depth within a micro market reduce risk more than expanding across cities?
Absolutely. I think having a large inventory in a relatively smaller micro market brings us a lot of cost arbitrage. I think we've been able to give better management focus. We brought down costs. I think that inherently reduces risk.
Right.
And the more we understand it, I think we feel we'll add more inventory in cities where we're already there. And the tailwinds have been in our favor. The locations we've started out 20 years back have really magnified into probably the growth drivers for India.
Right.
So we will continue to do that.
Great. And Manvendra, I'll come to you next. So your portfolio is built around highly differentiated leisure-based experiences. So does uniqueness or destination creation outweigh traditional advantages like based on the location?
I think uniqueness creates destinations in the long term. And it's not so much about whether this leads that or that leads that. Ultimately, from a consumer's perspective, what they want, at least for the game that I know, is the differentiation in the offering, the quality of the experience, the emotional resonance that experience can offer. And I think that that in the long term will always outweigh sameness and standardization, is my opinion.
That makes sense, yeah. And Nathan, I'll come to you next. You're scaling across emerging markets. So how do you determine whether the market is ready or is it too early to invest into that market?
So short answer, and not entirely in jest, that we go to the consultants, right? So Hotelivate tells us whether the market is ready or not. Obviously, if others are there already, then it gives you a better sense. And also where we are and the product is in its life cycle helps us understand. But we always go for external validation, not just on our gut.
Yeah, that makes sense. And Shwetank, coming to you next. Given Chalet's mix of acquisitions and developments, do you prioritize current cash flow visibility or long-term asset value?
Oh God, you asked that to a publicly listed company. What do you think the answer will be? No, we are very partisan in our approach. Value is right at the front and center of what we do. If you look at the nature of the beast of an asset-heavy company like ours, essentially the capital cycle precedes the revenue cycle, and that's a given. And that's how we look at all our investments. So funnily enough, cash flow is important. It is important for any business.
Of course.
And even more so in a situation like this. But having said that, cash flow for us is just one of the ways to fund our CapEx. And there are multiple ways to fund your CapEx. It is a very good way to fund your CapEx because you're doing it through internal accruals, but it is, to us, it's more like a gating item. It gives us confidence to do more in the future. So that's how we look at it. Value creation is absolutely embedded into everything we do.
Right.
Let me give you 2-3 quick examples.
Sure.
Whenever we look at any kind of asset sweating exercise, for us the simple metric is it giving us a return on capital employed higher than what the return on capital employed for that particular hotel is? Immediately it becomes value accretive. When people in our business save 1 rupee, we look at it as 1 into whatever the multiple is going on in the market as the value created for the business.
Right.
Even we'll take it down to our PR exercise. When we have a conversation or when we are putting out something, the first lens that we look at it is from, is it creating value to the investors? Will they understand what we are saying?
Right.
So it's absolutely front and center of what we do. So very clearly on the long-term value.
Great, that's great. And Vikram, I'll come to you last. But with Sterling's focus on leisure destinations, what matters more, accessibility or experience? We heard Manvendra's take on that, but it'd be great to hear you as well.
Okay, thanks. Good morning to you, Megha, and good morning to my fellow panelists. Good morning to all of you. So if I understand your question right, because there's a little bit of an echo, is in leisure markets, what's more important?
Correct.
Accessibility or experience?
That's correct. Yeah.
So for me, it's not a binary whether it's accessibility or experience, because accessibility gives you an entry into a destination. And that's the first point of entry. But experience actually drives long-term demand in that destination. I'll give you a little analogy of what it was 20 years ago and what it is today, for example.
Sure.
20 years ago, even the concept of holidaying or leisure was very nascent. And today it's developed into different formats of leisure travel, whether it's a spiritual travel, whether it's wildlife travel, etc. So I think the industry and we hoteliers and a lot of the other ecosystem has helped transform the leisure travel from what it was 20 years ago to what it is today. Step number 1.
Yeah.
And how did that happen? The first step that took place was better connectivity first into those destinations. And when there was connectivity into those destinations, supply started growing in those destinations. And when supply started growing in those destinations, one needed to differentiate oneself from the other and give and offer a reason for the customer to keep coming back to that destination. So that's when experience starts leading.
Correct.
So it's not a typical binary function. I think one may supersede the other, but the first important step here is accessibility.
Right.
And today, so many markets are accessible. I'll give you an example, another one. Say Tipeshwar. No one knew of a Tipeshwar 20 years ago, 10 years ago, maybe even 5 years ago.
Correct.
Today, because of the national highway network, it's just 4 hours from Nagpur and 5 hours from Hyderabad. And it's one of the most emerging tiger reserves in the country. So accessibility is the first lead indicator. And then experience counts as to why a customer needs to go there.
Sure. Now, that's great. And that brings me to my second question, is because while identifying the opportunity is one thing, but how do you decide where how do you invest? So would it be a build, buy, or partner? So Gautam, I'll start with you again. Your recent growth has been through brand acquisitions. So are global brand partnerships becoming critical to deploy capital?
I would say, I think it would be very specific to each company's journey.
Right.
We've been in the industry for 30 years. We've built fair amount of capability, understanding. For us, it's not essential to have an international partner to grow, but for select markets, we have a certain specific brand portfolio. But if a market needs a product which we can't offer, we might look at it, but not essential for us.
Okay.
We've been very opportunistic in our partnerships. Strategically, we want to grow our own brand.
Right.
But select locations, opportunities, would be open to working with them.
So if someone comes to you with an asset which is not brand affiliated, that's also something you'd be interested in, right?
Yeah.
Okay. That makes
But we've also seen that some kind of assets will need a certain type of partner. But again, the counterpoint to that is how distribution is getting democratized.
correct.
I feel one of the greatest tough times to do independent brands.
Right.
So,
But how do you pick between what kind of a asset will need a brand partner and what may not?
like our foray into OMR,
Right.
the asset was at a certain level very cookie cutter. We wouldn't have been able to put our brand to it.
Got it.
Our brand had a lot of F&B built into it, and I think some of the international brands do a good job of distributing fairly simple products,
Right.
which might be counterintuitive to a lot of people, but
Yeah.
we would use the brands to
That makes sense. Yeah.
make sense. Yeah.
Thank you. Manvendra, I'll come to you next. So you've traditionally avoided M&As. So how does your partnership with small luxury hotels help you scale?
So it's for a very specific function of distribution
Correct.
in certain markets that we partnered with SLH. I think for the game that we know and the game that we want to play, we need to have complete authorship from selection of the destination,
Right.
to execution of the project, to understanding what kind of partners will help for that context. And we need to have a complete authorship on the entire thing. So depending on what the function we are solving for,
Right.
we need to get partners. And for scaling any enterprise with specificity, with story, which is really what
Essence
we
of
hope
what
to
you
do,
Yeah.
we feel that one will need to work with partners all along. But we want to only work with partners for the hotel company that we want to establish that add value without erasing identity. And
that's critical for you.
That's critical for us.
Yeah. No, thank you. Nathan, coming to you next. So across your expansion plans, where are you seeing more opportunity? Brownfield, greenfield, tie-ups?
So as a group, we've really looked to scale up fairly quickly. So obviously, greenfield is really not, really doesn't fit in with our objectives. In India, the gestation period is quite long. I was just looking at the report yesterday, which was circulated. 5 years is the average. So that's a long time to wait for something to get to market. So for us, we've been looking at acquisitions,
Right.
Or brownfield, where it's sort of the last mile, maybe 1 year to market. So that's kind of driving our strategy. It doesn't mean we don't look at greenfield. We have acquired 1 or 2 land parcels, but with a long-term horizon. So there's no burning sort of objective to monetize that quickly. As a group, we do, we're comfortable sitting on land for some time as well if needed. But from hospitality primarily, it's largely brownfield or acquisitions. Yeah.
Okay, that makes sense. Shwetank, coming to you next. So you built your portfolio with global brand partnerships, but you're also building your own brand, Athiva. So how do you think about global partnerships versus owning your own brand platform?
Yeah, look, coming back to the original question on value creation, and this is one of those value creation questions for me, this one as well. If you see, at the end of the day, that focus is very clear. So we love our brand, but we are not tied to our brand. So that's the first differentiation. We like to make money, and that's our only love, right? So our decision tree is very clear. Once we have zeroed in on a location, the decision starts from which brands. Then the next set of decision is management contract or franchise.
Right.
And then the next decision is own brand or somebody else's brand. And then the fourth decision is own brand alone or own brand with a soft brand to get distribution. So that decision tree is relevant for any location that we pick up. And interestingly, the way we have set up our corporate office is that the Athiva team has to fight as hard for a location as a Hilton or a Marriott does. Yeah, Marriott fights the least, but that they are aware of. That's the relationship we have with them. But that's how we look at it. We would love to, of course, we want to grow the brand. We believe it's one of the experimental doors that we are opening for the future. But right now, there is no plan to go asset light. The idea is to first prove to ourselves that we can deliver the core of the brand, and most important, the promise to our customers again and again and again, day in and day out. And as we are all aware in this room, the number of touch points there are in hospitality, it's incredibly hard to be consistent. And sometimes we undervalue the job that the big brands are doing, because they've actually made a science out of an art. That's not easy to do.
Right.
But having said that, we are on that journey, and we are trying to sort of prove to ourselves that it can be done.
No, that makes sense. And Vikram, there are news reports about a proposed demerger of the resorts business from Thomas Cook. So how is your capital strategy evolving?
Okay, one, it doesn't make a difference. So we are demerging, and we will demerge soon.
Right.
It doesn't make a difference to how the capital structure is deployed, because we are self-reliant, and all Fairfax companies globally need to be self-reliant, number one. Number two, if coming specifically to what's happening, what we believe in an optimized approach between owned, leased, revenue share as well as managed. I don't believe in franchises. It's like a live-in relationship. But, and it's a question of how we optimize all these three kinds of contracts. And when we're doing this optimization, one has to keep in mind how the impact is in the P&L as well as on the balance sheet, number one. Number two, in the last 3 to 4 years, our net worth has gone from a minus 1,500 to a plus 1,500, excluding land reserves. And when we're talking about land reserves, 67 acres of our land that we have our own hotels, we sweated those assets. And I think that's a smart thing to do when the industry is reviving and it's actually on a growth path. So at a small incremental capital cost, you're actually able to sweat the asset more, and you're able to get better EBITDAs and PBTs, number one. Number two, you're talking about the fact that we have another 140 acres yet to be developed. So while we are in all the three models, it's a question of how you optimize it for what your balance sheet objective is, for what your P&L objective is. We always believe in return on equity and not return on ego. So I think the fact of the matter, we have to be really careful in actually selecting what we want to do and when. We are also completely debt-free. We became completely debt-free in the last 3 to 4 years. And I think that's the route that we will take. We will take an optimized route between these three approaches.
But there's not a favorite amongst the three approaches, is there?
I'm so sorry?
Amongst the three approaches, is there a favorite to really?
I think it depends on the objective. It depends on what you want. And it depends on what is the short-term impact and the long-term impact. So there's no one specific model, one specific destination that's needed. I just believe in a particular equation on a ratio. Sure. I think some of the hoteliers will also agree with me. I think you need to work on a ratio of 1:8 to 1:12. When I say ratio of 1:8 to 1:12, is one owned or a P&L impact room versus an 8 or a 10 asset light room, for example. So that's the ratio that one needs to work on, because that's the yield impacting on your P&L. Now, it obviously depends on what percentages one works with, whether it's a mid-scale or an upscale or an upper upscale. So therefore, that ratio varies. You can't go over asset light, you can't go over asset heavy, but it all depends on what your entire end objective is.
That's helpful, thank you. So we've really talked about where the opportunities lie, how capital is being deployed, but every investment comes with risk. So let's again get a quick sense from the room on where the risk lies. We'll bring in another poll. So the question is, what is the biggest risk in hospitality investments today? High land prices, execution delays, overestimating demand, or seasonality? We'll just give this a minute more. Demand started up quite low in the order, but it's moving up.
Meanwhile, shall I give you my view on it?
Sorry?
On this question.
Yeah. 100.
So, because we've been doing this for a while now, and we know that it's incredibly hard to develop hotels in India. But I can tell you that the biggest risk that resides in the cycle is between the time you acquire the land to the time you get the approvals for the concrete to start pouring. And that period is so unpredictable that it could be 6 months, it could be 1 year, it could be 20 years.
Right.
Once the concrete is pouring, and if you don't have a capital issue, then you can fairly predict it to a 3-4 month window, maybe even a 6 month window, but it won't change your life.
Yeah.
But this period between land and launch is the scariest.
Yeah, that could really change things.
So I would suggest that that's the biggest issue.
But from the audience, execution delays seem to be taking 46%. But the way I look at it, be it execution, land prices, or seasonality, ultimately, I think it'll all come down to one thing, is demand visibility, right? And that brings me to my next question. What's the primary demand for your business today, and how sustainable is it? Gautam, I'll start with you again. So are you still largely corporate driven, or are you seeing diversification?
Oh yeah, we are predominantly corporate driven. Close to 60% has been contracted. But what's changing is how the corporates, we're connected to the corporates.
Right.
How we used to have field teams being in touch with companies, but now the connection is more digital. So we'll continue to be a corporate driven, while our newer assets are on the leisure wellness side, but I think our
focus will
bread and butter
will
continue to be corporate for a while to come.
Okay. And Manvendra, your model is clearly experience-led. How resilient is that demand across cycles?
Sorry, can you?
I'm saying your model is experience-led, right? But how resilient is the demand across cycles? So maybe weddings attract a lot of business, but across these cycles, how is the demand?
Yeah, I think that the next story that we want to create is to take old historic sites across regions which have very good fundamentals and create culture districts there, create experiences that are so place-based that we are the only source of supply in those markets.
Right.
So it is about taking high-risk vanguard positions in markets that have strong fundamentals. And I think that if we manage to create those destinations, which we seem to have done in some of the projects that we have done, I think that then the demand will be led by the quality of the experience itself.
Right.
And because in some contexts, we are the only ones providing that demand.
Yeah.
I think we should enjoy long-term monopolies in those markets.
Right, but you don't see it typically in the assets you currently own. Do you see the demand get affected by, say, like the summer season or otherwise? Like, do you see a...
Yeah, I think we are more conscious about the markets that we choose now.
Correct, yeah.
So I don't see that seasonality to be as big a problem as we have experienced in some of our previous developments.
Got it, yeah. Nathan, coming to you now. Are weddings in MICE now strong enough to anchor demand in regional markets?
So I think it's destination specific, right? There's no one size fits all.
Right.
For example, we have the Radisson in Guwahati, which has been leading the market, is one of our highest performers, and it is driven by MICE. Okay, so we just recently built the largest banquet hall in the city to capitalize on that business. Not so much weddings, because in the Northeast, weddings, while the numbers are large, the spend is much lower, right, than you have in Delhi or in the North. So, but it's MICE driven. Whereas you go to Jaipur, weddings obviously play a much larger role. Bangalore, much more corporate and MICE rather than weddings. So I think you have to look at where your hotel is and what is the driver for that particular space. But undoubtedly, I think across weddings are still a large piece in India and will continue to be. But probably not the only thing. Yes.
Right, yeah. And Shwetank, are you seeing a structural shift in your portfolio when it comes to leisure assets?
See, look, the way we looked at it is that it was always a diversification strategy for us. If you ask us where our heart lies, we know we make our most money in big boxes in big cities.
Right.
So actually our development strategy is very plainly stated in 3 sentences. We want to be in big boxes in big cities just ahead of the infrastructure curve. We want to be in leisure destinations which are drivable from any major metro airport. Major airport, not metro airport, any major airport, and drivable distance for us is 1.5 to 2 hours. And then the third thing is that the quantum of EBITDA that the hotel produces has to be above a certain number. If it's below a certain number, even though the margins may be 40–50%, we don't bother.
Right.
Because for us, we know that we have 8 to 12 hours of work that the management team can put together, and return on management time is very important. So all 3 put together is how we look at it. During COVID, we realized all our eggs were in a same basket and we wanted to diversify. As you know, since then we have been in a bit of an acquisition spree.
Correct.
And we have gone and acquired quite a few of the leisure ones because we know we can't build them. We love owners who build them well and then they don't want it in their portfolio. We are very happy to take it off their hands.
Right.
We know that the execution risk in those locations are so high that we are happy to pay a slight premium over the market and sort of reward that particular owner for taking all the risk and having the vision. You know, classic example is that we bought the Westin in Rishikesh.
That's right.
And I was speaking to one of my promoters and he said that if somebody had bought him that land as a piece of land and said, why don't you build a hotel, he would have probably lost his job. So, you know, that's how little we'll take a risk in an off location.
Yeah.
But if somebody has the vision and builds a beautiful hotel, like Mankind did for us at the Westin, more than happy to take it off their hands. So that's
it's not going to be a one-size-fits-all.
So overall, we still, our heart is in big boxes, but we will diversify. The target that the board has given us is 20% of our revenue should come through leisure. So that's how we look at it.
That's good. And Vikram, has domestic leisure now become a long-term structural demand driver?
If I understand your question, is leisure become a long-term demand?
Domestic.
See, it certainly has, because again, if you compare to what India was 2-3 decades ago to what it is today, travel patterns have evolved. Domestic demand is, in my opinion, the key driver here. And if you want to really underwrite your game, it's domestic. But whatever happens in whichever part of the world, at least to some extent, domestic will hold fort out here. And so one is, there is a structural shift when it happened 3-4 decades ago to what it is today. Again, there is another structural shift that's going to happen in the next decade. And what is that structural shift? That structural shift is not a pure play leisure market that will work alone, but where there's a cusp of both business and leisure. And I think that's where the game is going to change towards. Some people say, diffuse different terminologies, tier 2, tier 3. And I think the purpose of travel will change from pure corporate or to pure leisure, and in leisure, different formats of leisure, into those markets which gives you a cusp of both leisure and business. Now, if you see one of the aspects that I was surprised, they said seasonality is so low.
Correct.
And I think for us, while we all understand execution delays is an in thing, with the number of licensing and etc. that one has to do. What surprised, and land will always be expensive. If you had asked this question 5 years ago, the same answer, land will always remain expensive.
Yeah.
But I think the biggest risk over here is seasonality. And I think that's where this leisure game will shift to leisure come corporate. So I may go for 2-3 days for a particular business visit, and I will actually club that with leisure, or in those destinations where I can do both. And I think that's where the game is going to shift, because seasonality, was surprised, is actually the lowest.
Yeah.
But if you have to see sustained performance through 365 days in a year, I think seasonality is our biggest risk today.
Correct.
You see, even if you're in a pure play corporate market, weekends are dead. You have to bank on non-residential business to sustain yourself. In leisure, it's just the ulta, or it's the opposite. 5 days in a week, you have to build the demand, and 2 days, you have to only maximize the demand.
Correct, yeah.
So, which is why this cusp of leisure and business will actually stretch the demand driver on both ways. And that's what's going to happen in the next decade.
Yeah. But coming back to the poll, right, we saw...
Can I just add something there, slightly counter view?
Yeah.
See, risk by definition is what you don't know or you can't control. Seasonality is known. So when you go into a place, whether it's weekly seasonality or annual seasonality, you're going in with your eyes open. You know what it works. Now it can be like Goa, over years it will change and become annual, wonderful. But you building your business model on that seasonality. So I don't see that as risk. If it's not viable, you don't go in it, period. Yeah.
But what would you then see as the biggest risk?
No, so you create a business model that works on seasonality.
Right.
If you then find it viable only, then you invest, right? So.
Yeah, and I was just coming back to that. The audience clearly thinks execution delay is the biggest risk. So any thoughts from any of you of how you all have navigated that across your assets?
If I were to take that, I mean, just picking up on what Shwetank said, when capital is not an issue, I think execution risk is just a matter of a quarter or here. But I think we've seen cases where we acquired land, it's taken 5 to 6 years before we could actually get the regulations aligned with what we wanted to do. But I think it's improving. A lot of states have become a lot more liberal on buildability. So I think the biggest risk is acquiring the legal due diligence and acquiring the land. Land is a big entry barrier. Not necessarily price, but getting quality land parcels in locations you want to be is a challenge. Yeah.
Anybody else wants to take it?
I think go-to-market is a risk out here.
Right.
And if you see in other markets apart from India, the go-to-market is faster. And if you see even what our Honorable Prime Minister is trying to do, make the ease of business, I think it's a very good step ahead. And if you're able to go to market faster, it's good for all of us, it's good for the economy as well.
Yeah.
And rather than having a long drawn wait to this whole thing, see whether it's your own asset or a partnered asset, go to market will always be an issue.
Of course.
And I think one if the ecosystem is taking right steps in this direction, I think that's something that we have to, laud. And how quickly that can get operationalized, I think we also need to work with government to get that done.
Correct, yeah.
So that we are able to go to market faster. Yes, that's what they say, execution risk. That is a big thing. And when Nathan sir was speaking about seasonality, I was speaking about from the fact that yes, you will build your models based on seasonality, but where do you need the return on capital employed faster? When your seasonality flattens out, you can actually be ahead of the curve out there. That's what I was trying to refer to.
Thank you. And let's now look ahead. So I'd like to end with a forward-looking question, and I'll come to each of you for that. One bold bet for the next 5 years could be a region, segment, or model, and one key risk. And Shwetank, I'll start with you first.
Yeah, okay. Ours is fairly clear. We are really betting on our brand. And, one very clever gentleman, I hope he's not in the room, I won't name him, but he gave me a classic line. He said, launching a brand is the best way to go from being a billionaire to a millionaire. So, it can be quite sucking in terms of time and resource and money, but it is a big bet. And I think the biggest risk that we have right now is that do we have the conviction and the fact that we will, we'll have to back it up with the right levels of talent. Right now, when you operate through a Marriott or a Hilton or whatever the brand is, manpower is their problem.
That's
not ours. Yeah. So, but it is a very real risk, and that worries us. And interestingly, on the manpower, I have a theory, and that theory says that it's not just the people who are operating the hotels. It's the entire ecosystem of hospitality today is under stress.
Yeah.
Whether it's your consultants, whether it's your contractors, whoever you look at. And it is very evident that the quality of work is dropping as it comes to you. And you have to be really on the ball, even though you're working with the best consultants and contractors, to make sure that the quality of work that comes to you is top drawer, because there is a talent crunch at their end as well.
Correct. So, that's across industries today.
Yeah. So everybody has the same challenge. So talent would be my problem. Building the brand would be the big bet.
Great. Manvendra, your thoughts?
I think travel, more and more people will seek meaning and memory over convenience.
True.
Therefore, we are betting big on regions that have uniqueness, that have strong fundamentals, and they are playing on India's rich diversity. They are in regions that have a very specific story to tell that has not been told before. And therefore, we want to bet on those regions. Right. And therefore, we don't want to develop hotels. We want to take historic sites and play on undervalued, under-recognized, underappreciated cultural capital, civilizational infrastructure. In a time when India is waking up to itself,
correct. Yeah.
I think that is what is going to give people a reason to travel, and I think they will choose memory and meaning over convenience. So that's what we are betting on.
And you've already done that.
And I think one big risk that I say only for myself is that sometimes you can misinterpret scale. And for scale, you need to optimize, standardize. For us, that is the biggest risk. That if we standardize and optimize, then
will you lose
we are not playing the game that we
started out with.
Yeah.
No, that makes a lot of sense. Gautam, your thoughts?
For us, it's been a long time coming, but we are entry into nature and wellness-driven resorts is a big bet for us. And we have a pipeline coming up in Andaman. So it's something we strongly, as a promoter group,
believe
want to be part of, but it's a business we have not done before.
Right.
I think it will come with what we little understand is the gestation period is much longer.
Right.
It will be slow to settle in. I think the talent dynamics also will be quite different. It will be quite different from what we've done in the past.
Yeah.
So it'll be an interesting and challenging journey. We're sure we'll manage the risk.
Right.
Yeah.
And apart from talent, do you see any risk in that? Gestation and talent is what you mentioned. Any other risks that you see?
I mean, I might add a layer of execution risk.
Right.
I mean, think about building in Andaman. We've seen enough in Coorg itself. I mean, we underestimated monsoon in Coorg. I think execution in leisure is
definitely
is something which needs a lot more resilience, if I would use the word. Yeah.
Fair. Vikram, coming to you next.
Okay, so I think India today is where China was 25 years ago.
Right.
In terms of the number of branded rooms per 1,000 people. What China was in 2000, we are actually in 2025. That's the biggest opportunity, number one. Number two is, in terms of also hotels with scale or resorts with scale, the average size in our country is about 40 to 50. And what we need is 250 plus. And how many hotels are there with 600 keys and over?
Yeah.
How many resorts are there with 800 keys and over? And one of the analysts did ask me this question as to why if Atlantis can have 2,000 rooms, why can't a hotel in India have it, right? So I mean, it's a point. So the opportunity is there in terms of penetration and in terms of scale. However, while we all say the risk on the other side, I think the risk is over commoditization. The hotel company with 20 hotels having 10 brands, for example, I think it's ridiculous. So I think the over commoditization is a risk, and that will impede or it will hinder sometimes the customer confidence as well.
Sure.
So we got to be very careful in dealing with it. The industry fraternity is very strong. We've all gone through COVID and come out of it.
Yeah.
Some of us are going through another wave in the short term, but I think we are very resilient. So we need to be cognizant of the risk that we carry and not try to overclutter the market, which confuses the customer and they losing their confidence in what they expect out of a hospitality brand.
That's good. Nathan, your thoughts?
So the DS group is a fairly conservative group.
Right.
Hospitality is a very small part of the overall group. So the advantage that we have in hospitality is that we have the anchor of a very strong balance sheet. Bold is a relative statement. We hope to be doubling our room count by 27, and those are all projects in the pipeline. So there's not too much delta on that front. And we do hope to grow further from there. But I wouldn't put them really as very bold steps. They're measured steps, like my colleagues have said here. And risk, again, I think we're all paid to mitigate those risks.
Yeah.
Of course, you can't do any business without taking some risk.
Of course.
But the point is that you work around it, and that's why we look at that brownfield acquisition strategy. So we minimize the execution risk, we minimize the funding requirements, don't over leverage, and then, barring any geopolitical challenges beyond our control, you should be reasonably safe.
And I'm glad that you brought up the geopolitical challenges. Would any of you want to just comment on, do you see that impacting your investment strategy in the near future?
Future, I don't know. I mean, I'm sure each of us has it. Few city hotels, we've seen it even in India, the impact.
Of course.
Okay, anyone who has a hotel in Bangalore, I think, has seen an impact this last month. But again, in the rural areas, you don't. So it's a mixed bag.
Take less leverage.
That definitely will work for any investment. Shwetank, any thoughts?
Sorry, I didn't catch your question.
I was saying, with the current geopolitical situation and the consequences, impact your investment strategy in the near...
Oh, the current situation you mean? No, interestingly, if you see the COVID playbook, you will realize that we went through a cycle or a series of actions that we took. And actually, if you see, we are practically following the same theory.
Right.
So the first thing to do is cut out discretionary spends. We've done that. The next is, what can you do with the manning? It's a structural cost. It's in the business. So before you ask people to go, the next step that you take is don't backfill people. And it's the one time that we are glad that there is attrition in the industry. So,
right.
So that's helpful. So you don't backfill people. So that's your second step. The third step, of course, is to then start to say, okay, what can we do with the salaries? What can we do with the people, etc. Then you start switching off, shutting down flows. So basically, you're impacting the P&L of the business. So only after that that you start to touch the capex. We are nowhere near that. In fact, interestingly, I got asked this question by a journalist yesterday, and he was very intrigued when I told him that we have actually sped up our capex. We have actually, and he was intrigued. He said, why? And the reason for that is that we have very successful hotels.
Yeah.
And when you have a very successful hotel, it is incredibly hard to do refurbishment in them. So in a hotel where you get 5-6 rooms to work on at a time, suddenly you may have a floor or two to work at the same time. So it's actually in Hyderabad and in Sahar, in Mumbai, we have actually sped up our refurbishment work. So accelerated the capex more like it. So actually nothing has changed from a long-term capex strategy.
Great.
If I may just
sure.
add in a point over here. I think in the last financial year, a lot of us have experienced a lot of headwinds and different kinds of headwinds as an industry. And I think this will continue to happen. Whether it's weather, whether it's Operation Sindoor, or whether it's whatever is happening now.
Correct.
We don't even know whether it's ended or no, and etc. of that kind. So these headwinds will be there. And I think what's essential, I said this in Feb 27th, the day before this attack had taken place, and no one knew that this attack was taking place. I said, in this whole quest to grow, and the whole growth story that we are all talking about, one essential aspect to keep in mind is efficiencies as well. So you can't let go of efficiencies for growth. Because when there is a severe headwind, it's very, very painful to do what probably many of the companies did in COVID. But that was a very precarious situation. So you got to constantly run efficiently, because in the growth cycle, you can't also increase your fixed costs disproportionately. And then tomorrow when there is a headwind, you don't know what to do with that fixed cost. And then you start taking knee-jerk reactions, which is not good for the industry. So I think while all of us are on the growth phase, we got to be cognizant of efficiencies as well, and not let that creep in, or inefficiencies creep in during this phase.
No, that makes a lot of sense. Gautam, Manvendra, any thoughts on this?
Yeah, I think we are in the business for long term, and I think risk is inherent, and geopolitical is one of the many. And I only think that it will separate the serious from the non-serious guys. I think we're happy to take advantage of each of these and grow stronger.
And apart from not taking a lot of debt, any thoughts?
Yeah, I think that I'm probably the least suited person on the panel because we tend to think more like artists who go all in, and in that pursuit, the only two friends that we have is to take less leverage, and B is to make sure, to Sir's point, to keep unit economics in check. And with those two fundamentals, go all in, and there will be headwinds and there will be uncertainties. That is the nature of the age that we live in and are ushering in. But I think the fundamentals are right. If you create memory, meaning for people, at least in hospitality, in the world that is becoming more commodified,
that's right.
I think that will always have value. So, all in.
That's great.
Yeah.
We do have about a few minutes for questions from the audience. So if there are
sure.
any questions, maybe we can take 2 of them. So I think I'll just take the first question is how do your ROI benchmarks change when evaluating regional opportunities versus major cities? Shwetank, you want to take that?
Why should it change? There's no reason for it to change. But there is, there has to be an acceptance, and that acceptance is that when you run a resort versus a city, tight city hotel, the percentage margin will always be lower in a resort for a variety of reasons, and we all understand that. So once you have got your head around that, the number versus the capex shouldn't change. No reason to.
Sure. I'll take the next question, and Manvendra, I'll come to you for this one. So is the audience for regional hospitality markets still coming from metro cities?
Yeah, any place where people are bogged down with standardization and sameness, they look for unique experiences and then they come to these destinations.
Great. And I think we'll take about 2 more. And Gautam, I'll come to you for this one. If you were deploying fresh capital today, which segment would you avoid entirely?
Segment? I would avoid luxury.
You'd avoid luxury.
What would you avoid?
Luxury.
Luxury. Okay. Oh God.
And I think I'll just take the last one. So tell us about the Guwahati market with 15 new 5-star hotels. Shallow regional markets oversupplied, and will we face a 2008-like situation? Ethan, do you want to take that? I think that's directed to you. Yeah.
I don't know about the 15. Okay, as earlier speakers have said, a lot of announcements are made which don't have a lot of gravitas behind them. But certainly there is fresh supply coming in. I believe Guwahati has a market with depth. It is the gateway to the northeast. And so I don't think there's a challenge of oversupply for the foreseeable future. 15 maybe, but 5 or 6 definitely space for them. Yeah.
Got it. And Vikram, I'll take the last question for you. What's something the industry is over-investing in right now?
Industry is over-investing right now, I think, is in sometimes irrelevant technology, right? It's technology of no relevance sometimes, so it's good to have. But I think more important thing is in this quest to grow, trying to enter markets with a very high fixed cost deal. And I said that that's what's going to be a big risk in terms of increasing a fixed cost. I think that's where the over-investing is happening right now to show, some growth. And, and my also point is, sometimes this partnered approach also is a little bit of a question mark. But over-investing in terms of fixed costs is something which is a dangerous thing.
There's just one thing I'd like to add here. And I would urge you all to think about it, because I think this sudden interest in building inward-facing resorts. By inward-facing resorts, I mean resorts where the resort itself is the destination.
Right.
And there is no D+1 demand driver. So, either there is weather or there is, views or whatever. Those are, I think, being overdone right now, because they're all fighting for the same piece of pie. And that pie is driven on a growing Indian middle class and a growing population base.
Right.
I think we should watch out for that and not overdo it.
Sure. I'll come to you, Vikram, and I know time's up. But Manvendra, do you want to react to what Shwetank just said?
What? Sorry?
Do you want to react to what Shwetank just said in terms of focusing on,
Yeah, I mean, if you don't have a game plan and you're just trying to Me Too strategy, that's never a good strategy.
Sure. You wanted
I think this one point had come out here is in terms of someone had asked oversupply. Is that a risk in some of the markets? I think that's where the opportunity is, because I think we are undersupply, as I said, overall, and in certain markets as well. You got to enter those markets, and I'm always a firm believer that supply will create its own demand. Because when a lot of hospitality brands are in that market, they will create a reason for a customer to come to their market.
Correct.
Whether it's leisure, corporate, whatever be the purpose. So I think we are under-penetrated today. There will be a short-term impact for sure. But I think supply or oversupply, in fact, is not a problem. In fact, that's the opportunity.
That's great. And that's what I'd like to close with. Also, I feel regional investments is no longer one opportunity. It's multiple strategies, I think, playing out all at once. Thank you to the panelists, and thank you for hearing us patiently. Thank you.
Thank you.
Thank you, everyone. We now have